Often you have heard about capital expenditure. So every company, if it has to be growing, it has to spend money for expanding the business. Say for an example, a manufacturing firm. So it has decided to make a new product. So it will have to buy the new machinery to manufacture that particular product. So this new machinery which it is going to buy comes under the CapEx. So they will tell that it will require say 100 crore of machinery cost to buy that machinery and then set up the machinery in their plant and start the new product. But often CapEx is misinterpreted by investors, especially the retail investors. They think CapEx, capital expenditure, means cash burn. The company is burning the cash. Normally once the CapEx is done, it is recorded under fixed assets in the balance sheet of the company. So in the balance sheet, the cash and cash equivalents, if they are funding the CapEx through their cash and cash equivalents, then the cash and cash equivalents figure goes down. And if they are funding the CapEx through say pure debt, so they are borrowing money, then the cash and cash equivalents will remain same because they are not utilizing the cash but they are taking debt. Even the CapEx can be a combination of partial debt and partial cash as well. In that case, the cash and cash equivalent value also will go down in a balance sheet and the capital expenditure will be recorded in the cash flow statement in the operating cash flow segment of the cash flow statement. So overall in the balance sheet, the total assets remains the same. But if you see, once the CapEx is done and you have purchased a machinery, so machinery is having a total life, say 30 years or maybe 20 years as well, based on what type of machinery you are buying. So the cost of that machinery is not directly mentioned in the profit and loss statement as a purchase price, but it is divided over this life of the equipment, maybe 20 or 30 years. So if it is 100 crore, 100 divided by 20, else divided by 30. So that is the yearly depreciation they will mention in the P&L statement. And if it is through debt, then you will have a interest payment for the debt, right, every year. So that interest will come in the P&L statement. So there is a revenue, then there is some expenses, then you subtract the depreciation from that amount to derive the profit after tax. And also the interest rate of this debt, that also is subtracted from the figure to get the total profit. So if you buy a machinery, then the depreciation comes in and it impacts the overall profitability of the company. And also if it is through a debt, then also the interest rate hits in and then that also is subtracted from the figure to further reduce the profit, at least which is mentioned in the P&L statement. So many times people do play with the depreciation figure, and if the profit is lower this year, so they will decrease the depreciation and the overall profit looks inflated. But then this is to be noted that once you set up this machinery, this investment, it is supposed to bring in a new product or increase the productivity of that particular plant, and then it is supposed to hit the revenue, and then this is supposed to increase the revenue figure and hence the profit figure. But then maybe if the CapEx is done this year and it takes 2-3 years to set up the plant, so it will be a cash burn and it will not directly reflect in the revenue and people will think that it's a cash burn. But if you know that why they are setting up this plant and is it bringing in a sensible product into their portfolio and further increase the profitability going forward, then it is always sensible to invest in that company. Also, if you see, it is not just about the new product. If the new CapEx is done, it may improve the efficiency of the plant. So it may reduce the labor cost. So the expenses also comes down. So if the expenses comes down, the revenue increases, again the profitability increases. Also many times companies bring in CapEx so that their production capability is enhanced. In the sense, say if they are producing say 10 tons of steel, that will increase the, it is just an example, so that will increase, and after the CapEx it may increase to 30 tons, which is like 3 times. So 3 times the capacity means they can sell more products at better pricing, and with the volume play they will create more profit. So this also catapults the profitability of the company. So to conclude, CapEx can in short term give out an indication that the company is not making profit and it is reducing the profit, but then going forward once the CapEx cycle realizes, then really the profit jumps if the CapEx is done in an optimal way. So as always, long term, this CapEx play is bound to create good profitability and making the company valuations attractive. See you next video. Till then, happy investing.